March 2020. The market crashes. Panic everywhere. Fast forward 2 years and the Nasdaq has completely recovered. QQQ, the ETF that tracks the Nasdaq 100, is back to even. Anyone who held through the crash made their money back. Anyone, that is, except the people who thought they were being smart by buying the 3x leverage version. They bought TQQQ, the triple leveraged Nasdaq ETF, and that $10,000 they invested, it didn't recover. It became $2,200, a 78% loss in an investment that was supposed to track the market's recovery. And here's what makes this truly terrifying. This wasn't a crash. This wasn't some black swan event. This is math. Silent, invisible mathematical erosion that happens every single trading day inside every leveraged ETF on the planet. And by the end of this video, you'll understand exactly how it works. And more importantly, whether you're accidentally falling victim to it right now. Okay, let's back up. What even is TQQ? TQQQ is an ETF designed to return 3 times the daily performance of the Nasdaq 100. If QQQ goes up 1% today, TQQQ goes up 3%. If QQQ goes down 2%, TQQQ goes down 6%. Simple enough, right? It's not simple. And the reason it's not comes down to 2 words that most investors have never heard. Daily reset. See, TQQQ doesn't promise triple the return over a year or a month or even a week. It promises triple the return today, and then it resets, and promises triple the return tomorrow, and then it resets again, every single day. This sounds harmless, but it's not harmless. It's actually a mathematical trap, and I'm going to prove it to you with some basic numbers. Imagine QQQ is at $100, and let's say on day 1 it drops 10%. So QQQ goes from $100 down to $90. Now TQQQ, being triple leverage, drops 30%. So if you started with $100 in TQQQ, you now have $70. Okay, day 2. The market recovers. QQQ goes back up about 11.1%, and $90 times 1.111 gets you back to $100. QQQ is fully recovered, back to even, like nothing happened. But what happened to TQQQ? Well, TQQQ starts day 2 at $70. And it goes up triple the gain, so up about 33.3%. $70 times 1.333 is about $93.33. Wait for it. QQQ is back to $100. Fully recovered. TQQQ is at $93.33. You just lost $6.67 while the market went nowhere. That's the decay. That's the daily reset silently eating your money. And this was just 2 days. Imagine this happening over weeks, over months, over an entire volatile year where the market goes up and down and up and down. Each cycle, a little more of your money vanishes. Not because you made a bad trade, not because the market went down long term, but because of the path it took to get there. This has a name. It's called volatility decay, or sometimes beta slippage, and it is the single most misunderstood risk in leveraged ETFs. Now let's scale this up to the real example. And I want to be clear, the numbers I'm about to give you aren't hypothetical. This actually happened. 2022. The Fed starts aggressively raising interest rates. The Nasdaq gets hammered. QQQ drops roughly 33% from its highs. Brutal. But then, over the next year and a half, the market recovers. QQQ climbs back. By early 2024, QQQ has fully recovered and then some. If you held QQQ through that entire period, you're fine. You're back to even and then profitable. But TQQQ, during the crash, TQQQ dropped roughly 80%. Because a 33% drop times 3 leverage is devastating. But here's the part that destroys people. The recovery. When QQQ started climbing back, TQQQ climbed too. 3 times the daily gains. But those gains were applied to a much smaller base. And the volatility along the way, the up days, the down days, the sideways weeks, kept eroding, and eroding, and eroding. End result. That $10,000 investment in TQQQ was worth about $2,200. QQQ, fully recovered. TQQQ, down 78%. Same index, same time period. One recovered, the other was eaten alive by math. And this isn't unique to TQQQ. This happens to every leveraged ETF. SQQQ, which is the triple inverse Nasdaq ETF, UPRO, the triple S&P fund, SPXL, TNA, TZA, all of them. The more volatile the underlying index, the worse the decay. This is why leveraged ETFs were originally designed for day trading. They were built for professional traders to use within a single session. Buy at 10 a.m., sell by 4 p.m., they were never meant to be held long-term. The prospectuses literally say this. But somewhere along the way, retail investors discovered them and thought, wait, if the market goes up 10% a year on average, and I buy the 3x version, I'll make 30% a year. And on paper, that logic sounds beautiful. But it's completely wrong, because the market doesn't go up in a straight line. It zigzags, and every zigzag costs you. Think of it like this. Imagine you're driving from New York to Los Angeles. The straight line distance is about 2,400 miles. But you don't drive in a straight line. You take highways, detours, hit construction zones. Your actual trip is maybe 3,000 miles. QQQ takes that 3,000-mile route and gets to LA. TQQQ takes that same winding route, but the toll booths charge you at every single turn. The more turns, the more you pay. Even though you end up in the same place as QQQ, your wallet is significantly lighter. That's volatility decay. The toll booth of leveraged ETFs. Now, does this mean leveraged ETFs are always a terrible idea? No. Actually, in one specific scenario, they work exactly as advertised. And it's the scenario nobody talks about. If the market goes in one direction consistently with very little volatility, leveraged ETFs are incredible. 2019, for example, the market basically went straight up. Low volatility, steady gains. TQQQ crushed it that year. Up over 130%, 2020 after the March crash, another massive straight-line rally. TQQQ went on an absolute tear. But those periods are the exception, not the rule. Most of the time, markets are messy. They chop sideways. They have fake breakouts. They gap down on random headlines. And every time that happens, the decay machine turns back on. So what do you actually do with this information? 3 things. 1. If you currently hold a leveraged ETF as a long-term investment, understand what you actually own. You don't own a triple return version of the Nasdaq. You own a daily reset derivative that decays over time. That doesn't mean you should panic sell tomorrow. But you should know the math. 2. If you're considering buying a leveraged ETF, be honest with yourself about your time frame. These instruments are tactical, not strategic. They're for short-term bets, not buy and hold forever. If you can't watch your position daily, you probably shouldn't be in a daily reset product. 3. For long-term wealth building, stick to the boring stuff. Regular index funds, ETFs like QQQ, VU, VTI. No leverage, no daily reset, no silent decay, just slow, compounding returns that actually survive the zigzags. That $10,000 that became $2,200 wasn't destroyed by a bad market. It was destroyed by a misunderstanding. The belief that leverage works the same over years as it does over days. It doesn't. The math won't let it. And now you know something that most people holding TQQQ right now simply don't. If this was helpful, there's more on the channel. I break down financial concepts like this every week. No hype, no BS, just the math behind the money.